a lot of investment mistakes myself. And in learning from those mistakes and learning from those journeys, I've obviously crafted better ways of doing this the older I've been getting. Therefore, I'm able to also come and talk about it. So what is investing? Okay, this is going to be the very, very basic level. I'm not here to insult anybody's intelligence, but we have to start from the basics, okay, so that nothing is taken for granted. Now, you can see that the basic definition from a stock market perspective, investing is simply buying shares. And those shares are in what we call publicly trading companies. Now, if I set up a company today, like some people have, maybe you're a director of a company or you know people that have set up their own company, it doesn't necessarily mean that they're public trading companies because they've not been issued for people in the public to buy shares. Okay. So the public trading is a level that is attained when companies have reached a certain level and they're able to sell their shares to the public. And they've been put through what's called an initial public offering. Now, the approach to investing, a lot of people miss this part, that middle bit, which says long term. A long-term approach is what is recommended. And most times people want to get rich very quickly. They sow something today, they want to reap the fruits tomorrow, right? The world of investing doesn't work like that. You have to also be patient. You have to have long-term sight. And from what I have researched and experienced, for you to really see rewards in the stock market in particular, depending on the style you're following, it's gonna take you really staying in there for a number of years, at least 5 years if you're looking at long term. Okay, so just bear that in mind. Unless you are a day trader who trades and buys and sells the stocks, then that's a totally different thing. But that's something that an ordinary person wouldn't just do correctly, because most people that try to do that themselves end up losing money. Now, what is the focus of investing? The investing should be focused on the company's fundamentals. And what we mean by fundamentals is the performance of the company, the trend, the industry, what is going on in that sector, etc. Sometimes it takes some expert knowledge to be able to pick the right companies, and I don't encourage people to just pick companies without actually understanding fundamentals. Okay, so if you know me, you know I will always come back to basics first. We don't want to run before we can walk. Before you start thinking of investing, and I'm not saying don't think of investing, just bear in mind that it's important for you to have also looked at, have I saved an emergency fund? 3 to 6 months of basic living expenses is recommended. Obviously, it may not be practical for majority of people because the cost of living is high. For most people, people are probably living hand to mouth. You get paid one day, you've got bills to pay the next week or so. And for most people, building an emergency fund is not very easy, but it's worth trying. If you haven't, just to start with 1 month, have you got some savings at least that can help you in an emergency, a car emergency, an unexpected emergency, right? That's very important. Or you stop getting shifts at work, or you lose your job, or something happens that's uncertain. Do you have a little reserve somewhere? Because if you're going to be putting money into the stock market is going to be volatile like any other investment. And so you want to have access to some cash as well. I'm not saying don't think about investing if you haven't got an emergency fund, but just bear in mind that the priority works in that way. Are you in debt where you have high interest debt? And when I say high interest, the interest rate of that debt is exceeding 7% before before you go and invest, because chances are you could go and invest and your return is only 5%, but you are paying debt at an interest rate of 7%. It doesn't make sense because then you are being charged debt that you owe, but you're also trying to invest at the same time on the other hand. So we sort of need to really think about those kind of things to say, okay, you can do both, but it's about managing the interest rates and knowing how long you've got to pay for certain debts that you have. Obviously, if it's a mortgage, that's an ongoing thing, and you can obviously have a much lower interest. That's considered a low interest debt. Now, you also need to bear in mind before you start thinking of investing, what kind of a person you are and what kind of approach works for you. Are you a hands-on person who's going to be researching different companies so that you know what to buy? Or are you a hands-off person who would rather take an approach of just buying a basket of funds, as I'm going to show you what that is, for you to invest because you don't have time to be doing research. You don't have the expertise to make the decision for yourself as to which stock you're going to buy, right? So you need to know yourself and your competencies and your strengths. But we all learn, and this is one of the ways that you're equipping yourself with that. Now, understanding the stock market itself. So most of us have heard about the stock market, or we see stuff in the news. You can see on that diagram, you've got all those charts flying around with, with the stocks or the trades that are happening, right? This may not be who you are, but it doesn't mean that you can't benefit from the marketplace. And what is that marketplace? The marketplace is where investors will buy and sell ownership in public companies. So ownership of what? Ownership of cells. It's not a market you go to physically as such, but obviously we use online platforms, okay, for that. And what are the common places where these exchanges and marketplaces happen? So most of us have probably heard of the London Stock Exchange, or the New York Stock Exchange. So every country would typically have a stock exchange, generally speaking. Okay. Just remember to check that you're muted, please. So we've got the marketplace and we've got the exchanges, right? The trading platform is where the transactions happen. Okay, and that's where I'm going to show you as a Jenny or a Trish or a Tatenda or a Michelle that's on the call. You're not going to go to the marketplace. You're not going to go to the exchanges, but you're going to go to a trading platform, which is where the transactions happen for you to buy or sell the shares. Okay, and the transactions, the prices for the shares would typically be determined by the supply and the demand of that particular stock. Okay. There are other factors that drive the prices, such as the Wall Street guys, in terms of what they think, and then there's the politics side. I'm sure we all know what happened in April when Donald Trump announced news about the tariffs, and there was just so much noise in the news, and most stocks fell. And then all of a sudden, in the last few weeks, there's been a huge rise. Some people have made so much money just in the last few weeks when everything has bounced back. But the question is, how do you know what to pick, right? And those are some of the things we're going to deal with. Okay. Again, this is a bit of a revision of what I've said about key concepts, but I think we've sort of already defined the shares, which are units of ownership in a company. So if you have a company, let's just say I'm going to choose Coca-Cola, right? Let's just say. And Coca-Cola will have a certain number of shares that are determined by the size of the company and the size of the business, etc. And the shares that are available, if you want to buy one share, I'll show you on a website very soon in terms of how much one share would typically cost, etc. So you can decide, can you afford to buy one share? Some platforms will allow you to buy one share or more. Other platforms will allow you to buy what we call fractional shares. So let's just say a Coca-Cola share is worth, I don't know what it is worth now, but I'm just going to make up a number. Let's just say it's worth £300, right? But you don't have £300, you probably have £100, right? Some platforms will then allow you to buy a fraction of that share, and you can then always enjoy the rise or fall of that in proportion to what you have bought, okay? So your shares or equities will represent your stake in that company, okay? And then you've probably heard of dividends. And dividends are when those companies now make shareholders receive profits, okay? So the company makes a profit and it distributes part payments to the shareholders, okay? So instead of just enjoying the share price going up or having it going down, you can have the share price go up, but also receive dividends when the company makes a profit. So it goes to what kind of shares you've chosen, whether they're going to have dividends or not. Again, that is something I teach. So The reward, again, is for long-term investors. And then the third part of this page is talking about terms you might hear, which is you might have heard, oh, we're in a bull market, which is the bull there that's got the horns. So the bull is pushing through, and when we're in a bull market, it means that the prices of the shares are going up, or the prices in the market are going up. But when in a bear market, which is when that shows the bear there, it shows that prices are falling, okay, over extended periods. So I'm just dropping these terms because if you're going to be serious about learning about this stuff, these are just basic investment concepts and terms that you will come across. Okay. Now the next question is, okay, fine. What are the types of shares that are out there? Okay. I have included, again, common terms you might hear. So the shares, like we said, it's ownership in one specific company. Okay, so you own shares in whatever it might be, Coca-Cola, Nike, Adidas. You own shares in that if you choose to. The second type of investment will be what we call funds. Now, funds is a collection of many shares or stocks in one index, for example. So some of you might have heard over the years something called the FTSE 100, or you've heard of the S&P 500, right? So those are examples of index funds. And what that simply means is it's a collection of different shares in one basket that you can buy. Okay, so some of the funds can be based on the sector. So you can say the NASDAQ is a representation of technology types of shares, and that creates its own fund. So rather than you saying, I'm going to have shares in Google, I'm going to have shares in Apple, I'm going to have shares in different tech companies, NVIDIA, you then just go and buy the index, which has got a whole bag of that type of share. Okay, so that's what funds represent. Other types of funds will probably be based on geographical location. So the FTSE 100 will be the top 100 companies in the UK. So if you buy that on the trading platform, you're just essentially buying a representation of the top 100 companies, whatever they are, and they'll always change depending on which ones are put in or which ones are removed. Same applies with the S&P 500. Again, I'll show you guys some real sort of examples. The S&P 500 will be the top 500 companies in the United States, and those will be very common because that's the most popular index. Okay, so those are terms that you can start getting familiar with. Okay, as you progress in building your knowledge around this. And then we have ETFs. Okay, so these are quite similar to index funds, but the difference is you can trade them on a daily basis. They are like shares, but they also include many stocks. So it's a type of fund, but the funds tend to be more long-term holding, whereas ETFs, you sell them on a daily basis. If you'd like to, you've got that option as well. Then some of you might have heard of government bonds. These are not necessarily share investments, but it's purely when loans are made to companies or governments, but it's from public money. So you can buy bonds and then you get a return in interest. Okay, so it's a type of investment, but it's not a type of share. Now, I want to show you something that's probably, wait, before we go on to that one. I've got quite a number of tabs open. So I want to just show you something from, okay, oh, sorry, that's not it. I'm used to using two screens, so, okay, I think I found what I want. Oh, that's still not it. I've got too many tabs open, that's why. Okay, yeah, so that's the Zoom line, which is fine. I just want to show you something I was looking at earlier. Okay, so this is an example of the S&P 500, and I want you to just see, just as an example, okay? So you can see on this, it says that S&P 500 is the stock market index that tracks the performance of around 500 of the largest US companies, okay? So it's not an investment itself, but it's a list. But it's in the investment then becomes the index fund itself. So can you see here that you've got these companies that are listed. I'm sure you're familiar with some of them. So I've already named some. So you've got Apple, Nvidia, Microsoft, Amazon, Meta, which owns Facebook, Alphabet, which is Google, right? And you've heard of Tesla, all these different companies, okay? And they have these symbols that are then used on the stocks. But this just tells you that if you then buy an index fund of an S&P 500. It won't be named S&P 500 on the platform. It just depends on the platform that you use, and I'm going to show you that in a moment. But um, it's a it's an illustration of the companies that you can see, but at the same time, they change over time based on how they're performing. Okay, so the companies that formed the S&P 500 10 years ago are different to what they are now. But if you had invested in the S&P 500 10 years ago, you would still be enjoying the value of that investment no matter which companies are there. So it saves you from thinking to decide, am I going to choose to buy stocks in Amazon, or am I going to choose to buy stocks in Visa, or am I going to choose to buy stocks in Microsoft? Okay, so it just gives you that flexibility to allow you to sort of select and you just have everything in one basket. So I will show you in another illustration again very soon. Right, okay, I'm gonna go back to the PowerPoint slides. I've got the right page. Now, the magic question that everybody's probably wondering, for those that already have their shares and you've got these platforms, you already perhaps are using one of these. But I just want to illustrate then how you actually buy the shares, okay? Now, so the first thing you do is, like I said, you choose a platform the same way you choose a bank. Okay. You're going to choose, I'm going to bank with Halifax or Lloyd's, or I'm going to bank with Barclays. It's the same thing. Okay. You've got a wide variety of options. Now, I've got a separate slide and a separate session altogether that teaches about how you choose a platform if you're really keen. But personally, I like trading 2-on-2. I find it simple. I find it easy to use. Um, the other ones are also good. All of them have got their advantages and disadvantages, okay? Like anything. Um, so it just depends on what fits for you. But what you do is you essentially open an account, and my recommendation, if you're in the UK, which I think most of us are, and all of us, I think, is that you make sure you create an ISA version of that account. So it's either as a lifetime ISA, or that's if you're under the age of 40 and you want to save maybe for a first home, or even if you want to save towards your retirement. A lifetime ISA is good because then you enjoy the benefits of whatever is happening in the stock market plus the free government bonus that comes with that. If it's not a lifetime ISA because you don't need one, or you don't meet the criteria, then you just create a normal stocks and shares ISA within that platform. Okay. The reason why you want a stocks and shares ISA rather than just a general trading account is because you don't get taxed on the returns. So you would choose the platform, you then open an account, and then when you're opening it, they ask you to do all these security checks. I've got a separate session where I actually demonstrate it in full, but we don't have time to do all that today. But like anything, you go through the verifications, you open your account, and then the next thing you can transfer money into that investment platform. Once you've transferred the money, you then find the investment or the stocks that you want to buy, and then you place your order, and that's you have already bought those shares. Now, the question for most people is, how do I choose the shares? Blah, blah, blah. That's something that we'll also have to think about. But I just wanted you to just have this framework in your mind in terms of the step-by-step process and the examples of the different platforms. Now, some of you might have heard the term private equity, okay, which is also shares, but the difference is those are shares that are not yet on these trading platforms. So I've put an example of a company called Jambu. I'm sure most of us might have heard of it. It's a Zimbabwean founded um, bank that's in the UK. And it's an example of a company that people are can buy shares, but these shares are not yet on trading platforms because the company has not yet been put to what we call the initial public offer. It simply means that the company is a startup, right? And they're simply looking for investors. So, as an investor, if you then think they're onto something, or if you believe that there might be good returns in what they're proposing as a business, which is what Jeff Bezos did years ago, or some of the companies we now see, they started there where they were looking for private investors. Now, there are so many companies that get set up like that and look for private investors and they fail, but there are some that obviously then succeed. So it just then depends on your own risk appetite and knowledge of the industry and what your gut feel is about what these people are doing. So in Jambu, they are raising funds. They are now on a platform that Monzo also used when they were starting out, right? And people have been buying these shares. So you get a share certificate as private equity because you are an investor um, before it's trading. So you could have bought, maybe they're doing them for £1 a share, right? Let's just say. But by the time they become a public company, right, those shares could then be worth a different value if the company does well. Okay. So don't confuse the shares that you buy on the platforms with the shares that are for startups because they're still shares, but it's two different things and it's two different ways of operating because the startup ones, you're essentially having faith that this company is going to do well and one day it's also going to be added to a trading platform. Okay, so that's just some background that's important. So I thought this would be helpful in terms of bringing a practical example that some of us may have heard about. How do you choose a platform? I get into detail on this on different thing, but I just thought I would just quickly give you some basics on here. Is it FCA regulated? That's very important. That helps protect your investments. What are the fees that are going to be charged? There's going to be trading costs when you pick those stocks. Are there going to be account charges? All these things impact your returns over time. That's one of the reasons why people choose different platforms. And what's the investment range that this platform allows? Does it use both UK and international markets? What's available? Okay. And what's the user experience of that platform? The interface, how user-friendly is it? Okay, that's very important for you as well. So I guess that is hopefully something that you can figure out in terms of your preference. Now, how do you get to understand the company stocks? You've got all these, you get onto a platform. I'm just going to show you. I'm going to go back to I think I've got a trading 212 page open somewhere. Oh, did I close it? Oh, there it is. Okay. Right. So this is one of my dummy kind of little accounts with trading 212, right? And you can see when you get onto the home page, you can see here on the left, you're already getting examples. So can you see the greens? The fact that everything is green shows that the stocks are going up at the moment, right? So that's the FTSE 100. Can you see it says index, like I explained to you earlier, the UK 100. So if you buy that, it's worth 8,700 in value right now, but it doesn't mean you have to pay 8,700. You can just pay whatever you have, okay, once you've set up your account. This is Nvidia, a tech company. So it was very, very popular last year. It did very, very well. So if you click on it, you can see already it's giving you the option to buy, but this is how it's performed. Since it ever started, it's gone up by 36,000%, right? Which is, you can't even, I don't know how you even measure that. So this is back in June 2019, it was worth $3. Okay. So I didn't even know it existed in 2019, right? But those that did and bought it, if they were patient enough to hold on to it, it would have gone up in value. And now it's at today $135 dollars worth. Okay. So that just gives you an idea of what can happen with the stocks, right? The same way they can go up, they can also go down. But you can see that this is over time, a very long period of time of being patient and holding on, right? So all the various um, types of stocks, as well as commodities like gold. Gold has been very popular lately because when the stock market fell, a lot of people decided to put money in gold because they found it to be a safe haven. So you will see different things. But the question is, if you're new, you don't know what to pick because there is just so much. How do you know what you go for, right? And this is why it's important to learn the fundamentals of how you then choose the stocks and what options you have, especially when there's the option of the indices that I mentioned earlier. I only gave two examples, but one of the things I will tell you is there is an index that is actually called a FTSE Global All World Index, for example. The good thing about that one is, unlike the S&P 500 that focuses on just the United States, it focuses on the global market. So developing countries as well as developed countries. I personally like that because it balances the risk. But I will go back to the slides so that I can then show you what I want to say. So understanding the stocks. It's important to invest in what you know. So you start with companies that you understand and companies that you believe in. I work with some people who are very particular about the environment, and they will only ever invest in stocks that are environmentally friendly. So they actually exist, the ones that are like that, and that's how they're sold. So everybody likes different things, right? So you start with companies that you understand and you believe in. So personal knowledge there provides some insight, like anything, right? What if you don't know what you like? There's some people that are like, they don't know what they believe in. They just want to make some money. Okay, stay with me. Outside of investing what you know, okay, actually, let me stay on there first. There's an aspect here that's not on the slides that's written that I want to explain. So society has taught us to be consumers, right? We want to buy the latest bag, we want to buy the latest trainers, the latest car, the latest phone. So in your house right now, look at around you and think of the gadgets and the brands that you have. I don't know, you've got a Sony TV, maybe you've got a Lenovo laptop, or maybe you've got an Apple phone, or you've got an Apple Mac, you've got a Sharp fridge, you've got all these gadgets, um you've got a Nissan as a car, or you've got a Mercedes. All these brands and things are things we consume. But we also have to think about how have we got a stake in these things to even be getting something back? And this is where the stock market education is important because then you go to that platform I showed you on Trading 200 and you're like, I love Microsoft, or I'm a huge Microsoft user. I'm going to get something out of it. That's the mindset we need to operate with. So that as the years go by, while we are consumers that are consuming brands and things that we actually also have a little bit of investment in. Even if it's £50 or £100 that you've started with, you compound it and you grow it as you go. Okay, so I wanted to make sure I put that because it's not in an actual slide. Now, back to the technique. So invest in what you know, use research tools. So there are research tools like Yahoo Finance and one called Morningstar. Personally, I don't have time to do the researching. This is not my investing style, but I have to tell you the fundamentals so that you know what your options are. You also then have to look at financial statements. You're then reading to see how is the company performing, what is their financial health. Some people just guess and they just buy stocks, they just buy what's trending and it works for them. That's fine. But that's also then guesswork. There's no structure and there's no basis. So those that are really serious about investing in stocks, they would do the research if you're buying them individually. But if you're buying index funds or indices, then you're all good because everything is already in the basket for you. Okay, so just bear that in mind. I think I've already explained what index funds and ETFs are, but this is just a better breakdown to explain why it's important to consider them. Personally, I'm an index fund person. I like the diversification because what it means is I'm investing in hundreds of companies with one purchase. I'm not cracking my brain to decide which stock I'm picking. And I don't have time to do the research. Of course, I have in some individual stocks in common brands because I use them and I believe in them. But when it comes to the long-term investing, it's the diversification that I like from the index funds. The other thing you also find is it's passive management because you're not constantly looking at the market prices every day. Okay, so it requires minimum time and a minimum research. If you're a very busy person, then that works well for you and you're still getting to enjoy the rewards. Then there is also the aspect of the fees. So imagine you're constantly buying and selling individual stocks. You're going to incur high fees because every time you're doing those transactions, you're being charged. So if you just use index funds and every month you are buying those funds and accumulating them, in addition to what you are putting in, you are also enjoying the benefit of how high or unfortunately how low the trends of the stocks are within that fund. So the fees will be minimum as well as minimal, as well as the fact that the market research, um, the performance is better without picking individual stocks because you could pick 10 individual stocks, but three of them are doing great, the other two are just stagnant, and the other five are not doing well. So it just cancels itself out anyway. So it's very important to just make sure that you are checking how the returns are going for what you have chosen. And then I mentioned about dividends. So this, I know I appreciate most of this is very dry, but I just want to get to a certain point so that we can then have questions to answer, and I can show you a little bit something that's practical about comparing investing to saving. So dividend investing means that you're getting regular payments from the company in profits. Because you're a shareholder, you get that little income that's coming to you. So remember, I mentioned to you that I was inspired with this when I was doing tax consulting for people, because I would then do their tax returns and I can see, oh, they've got shares in BT, they've got shares in that, they've got shares in this. And I'm thinking, oh, so these people are a step ahead because this is not something that I've learned. And then I've had to then go back and teach myself that or learn from others, right? Or go on courses myself to understand how this works. As much as I was an accountant by textbook and an accountant by profession, some of this practical stuff you have to then learn as you go. So that inspired me. So the dividends would provide steady income. So imagine you've got an adult child, let's just say, who's even a young child, and you start investing for them and they're getting these dividends on an ongoing basis. By the time they're older, you can imagine the compounding that would have happened, with something like this. So you're evaluating dividend stocks. So you check what's called the yields and you look for the consistent payment history. That's how you then choose which ones you settle for if you want to get dividend stock. The secret, however, with the dividends is that when you get paid a dividend, let's just say you've got a share in Coca-Cola and they're paying you dividend of, I don't know, 50p, for example. It doesn't sound like a lot, but it's 50p, which is actually on average quite high per share. But some people could then have multiple shares. So you're being paid your dividends based on how many shares that you have. But instead of you taking that money out and saying, I'm going to use it right now, you can then reinvest that to boost the returns because then you now have a bigger stock volume that's actually working for you and it accelerates your wealth building journey. Again, it's about having a plan as to how many years you want to do this for. Okay, so this is just me sharing some fundamentals around the background. Now, I had said that we're going to talk about ISAs. I think I already did in another slide, but I just want you to appreciate the difference between your cash ISA and the stock and shares ISA. With the cash ISA, it carries barely any risk because it's purely just a savings account where you haven't got your money invested in the stock market. Hopefully, it's high interest, ideally, but it will be much better, less returns compared to putting your money in the stocks and shares ISA. So some people have both. They want the low risk cash ISA for their emergency fund that I started with at the beginning. And then they have the stocks and shares ISA as a longer term investment. Okay. So with the stocks and shares ISA, I showed you where you can open the kind of platforms you can open and you choose that you want a stocks and shares ISA because any of the gains you get there are going to be tax free and you can put in up to 20,000. I've seen people who maximize on this 20,000 investment every year without fail. And that's their trading strategy. because they've worked so hard and their aim is any extra money they get, it goes straight into the ISAs. It takes a lot of discipline and obviously it depends on how much you earn. But these are strategies you can always implement. But the beauty is there is nothing too little. It's the key thing is to start and then it builds up as you go. So rather than you having a pattern of just saving £500 a month or £200 a month or £100 a month only, saving it only, you are then channeling that money, whatever the figure is, into a stocks and share ISA and letting it compound based on how the stocks are performing and what you have chosen. Okay. So you can have your adult ISA, which is you can put in up to 20,000 if you're lucky enough to have that much. But even if you have 1,000 for the whole year, it's fine. You get started. So that could be for you as an adult, or you can open the junior ISAs for children, which have a limit of up to £9,000. The only catch with junior ISAs is once your children get to the age of 18, that account belongs to them. You can't manage it for them. So it becomes, because they're then considered an adult. So if your child hasn't had enough financial education or, they could blow that money. So you want to be careful about how you go around that. But I want to show you an illustration of saving versus investing so that you can really see the difference in terms of what actually happens when you actually, when you actually do saving. So I've got a Hargreaves Lansdowne page. Okay, I think I've lost it. Let me just, I'll just Google search it. Investing saving calculator. Okay, that one. So it's this one here, this Hargreaves Lansdowne one, because I looked at it earlier. Right. So I want you guys to have a look at this page. Okay. So this is a calculator that will show you a comparison of what happens to your money if you actually then put it in investment compared to saving. So let's just say you're investing each month. Yeah, I'm going to put a figure like 200. Let's just start with £200. Okay. But your plan is to do £200 a month, but maybe you've had, I don't know, a bit of a windfall. Maybe you've had a tax refund from HMRC, which is some sudden good news, or you've had a bonus at work or something like that. And you probably have a lump sum of £1,000. Let's just keep that at that. So you've got £1,000 that you have started with as your foundation into the investment, right? And this is a regular investing calculator. And you are then continuously putting £200 a month over 5 years, okay? The question then becomes, what is the growth rate of that investment? So that investment could be earning you back, I don't know, 5% a year, that sort of thing. 5% is very average. That's what you would probably get in a high interest savings account, perhaps. So let's just keep it at that. It's just for you to see what happens. So if we calculate that, you'll be able to see that after 5 years, right, your total investment that you put in, that you have will be 14,894, but you'd contributed 13,000. So your investment growth is about 1,894. Okay, it may not feel like much, but this is what would have happened in a normal investment that's just flat. Now, what then happens if you then do compound interest? Right. So compound interest is what then happens when, let's say you've invested in the stock market. The same amounts, we're putting £200 a month, and you had injected £1,000 first. So £200 a month is you putting money in an index fund. Let's just say I'll use index fund as an example because that's just easier to understand. Let's say you're using the S&P 500 or you're using the global all world cap that I mentioned. It's just a fund that's buying all the stocks for you. You're not having to choose. Okay. Now, the compounding beauty is that you are not taking anything out yet, but everything that you're putting in, the gains that are coming from the returns of the stocks, let's just say at that point, okay, let's keep it at 5% because I just want to see what the difference is going to be. I'm sorry, I have to put it at a higher rate. Okay, so if the return is at 7%, you can see that, okay, your contribution is still 13,000, but your growth is about 2,722. The point I'm trying to illustrate here, ladies and any gents, if they're on the call, is the fact that the investment rates you're going to get in the stock market would tend to be higher than this. But if you are saving or you are using a flat investment that is yielding you continuously 7% a year, right? This is the amount of growth you're going to expect. So for you to accelerate this growth, you're going to have to also be putting in more money. The same way you would in a savings account is the same way you would do in the stock market. The difference with the stock market is this percentage is going to be different. The average return with the S&P 500 on average has been around 11%. Okay. So what you would get in a savings account after 5 years, if you're putting in £200 a month, you would end up with 14,894. Let's just say it's at a 5% rate. But from what has come up on average, this is only going up to 8%. You can see that as long as the returns are higher, right? So based upon historical performance, the S&P 500 and most of the indices have outperformed individuals that have just taken individual stocks. So what I'm just trying to get to is the fact that you will ideally get higher returns in the stock market, but there could be years where that percentage drops when the market falls. So like what happened last month when Donald Trump made the announcements about the tariffs, I'm just using that because it's quite recent. There was a big drop in the stock market, but that was caused by announcements, political issues, and things like that. A couple of years ago, there was a war in Ukraine. You can imagine what that would have triggered, right, in the stock market for certain stocks. So you need to make sure you're paying attention to what is happening around the world. You're not panicking because there will be good years where the returns could be as high as even 24%, right? This calculator is not even going that high. So what's important is to get in and to have the investment there working for you for as long as possible so that you can ride through all of the waves and you can get better returns than what we can see on this calculator here. Now, I want us to just look at what the investment strategies would be. So I think I already mentioned that passive investing is when you take a long-term approach and you are using index funds, which I gave examples of, right? With the S&P 500 and FTSE 100 and the global or world cap, for example. The other strategy is the active investing, which is on the right here. And that's you going in and selecting individual stocks, which you can do. You can go and select the individual stocks, like I showed you on the Trading 212 platform. You could see different companies. The difference with that is it's a higher potential, there's higher potential returns that you could get, but it also comes with higher risk, okay? Because you're putting your eggs in one basket, essentially, okay? Then there's some investors who follow a strategy called core and satellite, which means that you've got the funds as well as some stocks. And personally, I like that because I then get to enjoy the best of both worlds, okay? And then the other strategy is a pound cost averaging, which means that you're constantly, the same way you would have a saving plan to say, I'm saving £200 a month, you would then have a pound cost averaging approach, which means that you are regularly investing £200 a month. So no matter what's happening in the market, whether the markets are high or low, you're constantly putting that money in, and then it rides those waves, and then you get the benefits at the end. Okay, so these are the strategies. Now, the question you may be asking yourself is, how do I manage risk? Okay, investment risk, right? Volatility is going to be normal. Okay, if you've ever invested in crypto, that is the most volatile investment you can get, right? You can go for. But it also has the highest returns when you get the returns, they come really high. But when you get the drops, they go really low as well. For the stock market, you have some level of volatility as well. It's a roller coaster ride. Okay, there'll be market fluctuations, so expect ups and downs in prices. But the key thing is to spread your investments across different sectors and regions, which is why, again, I'm going back to the index funds because those do it for you automatically, okay? You need to have a long-term perspective, right? If you're going to be investing in the stock market, you need to have a long-term investment. If you have a short-term view, chances are you won't recover or make as much money as you can unless you have learned how to trade, which is to do the day trading. Okay. It's gonna take a lot of emotional control because sometimes you're gonna feel like you've missed out. I showed you guys the illustration of Nvidia where there's been 36,000% rise, right, in the stock price. You'd be like, oh, I wish I'd known about it. Or you make a decision and it's not a right decision. There's always gonna be things that you have to avoid in terms of panic selling or panic buying. You shouldn't chase trends impulsively and have this FOMO going on because that's the thing that impacts a lot of people. You'll have YouTubers, you'll have people saying things, there'll be stuff on the news. Of course, you have to listen to informed sources, but chances are your emotional control is going to be very important. Now, if you have a pension already, whether it's a workplace pension or it's a private pension, you are already invested in the stock market there, but you're just not the one who's controlling those investments, okay? Amongst other things. So it will be a mixture of different types of investments. So the difference with this is you're adding it on top of what you probably already have in your pension, which is increasing, hopefully, with time. So I covered this about debt as well. This was another slide where I just prepared to say, please tackle high interest debt first before you max out on going into this investment spree, because the interest rates on your high interest debt will kind of suffocate your investment because it cancels out. There's no point. So of course, things like mortgages or student loans or low interest debts will be fine for you to manage while you're also building an investment, but always remember to have that emergency fund. Now, we're almost getting to the end and then we can do questions. So I think it's already been after past, so hopefully we'll be able to get through. So this is just an illustration of why it's important. So there's something called market timing, which means you're hopping around to buy stocks at different times and there's no pattern. Maybe it's based on what's going on or the news or whatever, and that's the time that you buy. And then there is something called time in the market, which means how long you stay within that market, right? The longer you are within the long-term ride, the better. Okay. So on average, the annual returns people have gotten from the FTSE 100 historically is about 7.9%. And if there's been a crash, the recovery rate is normally about 75% within a couple of years, okay? Unless there's a drastic change like what has happened this year where an announcement is made and another announcement is made to say, oh, we're going to give 90-day break to the tariffs, and then suddenly the markets pick up again, okay? But chances of failure, if you're just timing the market to just jump in and out sporadically, chances of failure can be high because you're not able to be in it for the long term. Okay, so the key thing is you may not have started investing yet. Yesterday was the best time to invest. According to Nvidia, 2019 was the best time to invest, but we can't go back, right? The key thing is today becomes the second best time because whatever amount of time you have left is the amount of time that you can give yourself to enjoy the compounding of what you have invested in the stock market. Okay, so time in the market, the length of time you have your stocks in the market is important because it's a long-term investment. Now, I don't want to leave you hanging because I appreciate what I've given you today is a lot of foundational knowledge, a lot of terms, a lot of little examples. Would you be ready to get started? It depends on how much you already knew before this. But what I would recommend is if you're going to use the mobile apps, I think I showed you some of the platforms, Free Trade, Trading 212, Hargreaves, Lansdowne. They're all there. You can download them and have a look and have a play around. If you're not sure, then I recommend that you do some extra reading and some extra learning, right? There's an amazing book I read, which is called The Simple Path to Wealth by J.L. Collins. It's like the best investment book, I think, that has a good record, if I can put it that way, in terms of simplifying communication, making you understand time in the markets, thing that I've explained about, make you understand index funds. It's a brilliant book. It's a man who's talking about his investment journey, but he's talking about his daughter and how he started helping her out and things like that. Absolutely amazing. And he gives illustrations about, for example, I gave that £200 a month example. If you were putting that in the stock market versus you paying that on a car loan, which is a
Okay.
depreciating asset, you'll be able to see the difference in that. Okay. Another good book is called Money. It's just called Money. It's a user's guide. It's by Laura Waitley. For any readers, you can do that and get yourself more equipped. What I've also done is I've got a full course, which is what I call the Investing Made Simple, right? So that full course has got, it's on the website if anyone has already been on. The full course is, just show it to you, it's here. Yeah, you'd normally see it here. It normally says it's this one here. So it's Investing Made Simple. It's a step-by-step guide for beginners. So it's the next level after we've already covered what we've done today. Remember, I said we can't do everything. So what I've done is it's 3 videos, right? So I go through the platforms, the pros and cons, the how you choose, what to consider, etc. That's the first one. And then the second module is about the strategy. What strategy you can use in terms of the stock picking, in terms of the indices, the passive investing versus the active investing, whether you want to be picking stocks, or you'd just rather not, right? And the risk tolerances, I look at diversification, that's all in the second module. Then the third module is a walkthrough of actually getting started, and how you open the funds, the common mistakes to avoid, that kind of thing. So this is an advanced aspect. You can see it's on the website. I'll share it with the link afterwards when I send the recording. It's there and it says it's £47. But for you guys, you know my style. I'll always give you a discount because you've already invested in attending this. So if you want to go on there and do that course, you're more than welcome to. If you use this code stocks27 when you pay, you only pay £27 instead of £47. So that's just something you can consider. Okay, so I'm gonna come off the screen now, and then we can discuss our questions, and hopefully we can talk through what you guys are thinking or what you want to check with me. I think some people have written stuff in the chat, so I'm gonna stop sharing. Do you find all stocks on standard accounts or tax efficient ISA? Yes, so all stocks can be found, but it depends on the platform. So there was a slide where I was saying when you're choosing platforms, it depends on the range of stocks that are available. So some platforms might not have certain items, but the common stocks you'll always find, whether it's a standard account or a tax efficient ISA. For stocks and shares ISA, because of the increased competition and things like that, there may be some limitations on some platforms, but yeah, the answer is yes, you do find them. Can you move a child's ISA from a savings bank into a global market? Can you move a child's ISA from a savings bank into the global market? So is this asking, is the child's ISA a stocks and shares ISA? Who's asked this question? Tatenda? Do you want to elaborate on the question? So it would depend. Okay, so it's a normal ISA, which is probably, yeah, so I'm assuming it's a stocks and shares ISA rather than a cash ISA. So that's what I'm just trying to understand. So you can change. It just depends on the platforms. So some platforms can allow you to migrate from another one to them. Others might not. So you just have to check what the restrictions are or what the guidelines are based on where you want. Yeah, so if it's a cash ISA, you can take the money out depending on the terms of that cash ISA. Is it one that's free access? Has it got any restrictions? You can just take the money out the same way you would when you want to take out your money. But if it's the child ISA, obviously they can access it when they're 18 for themselves. That's when they can sort of enjoy, but you can transfer it, yes, to another provider. How long is the advanced course? So the videos are on average about half an hour each. They're not too long. But the third one, I've re-recorded it, so it's gonna be replaced because I had to do an upgraded version. So yeah, so it might hit over 30 now, 30. So it's not very long. You can probably finish it in less than 2 hours, the whole course, or an hour and a half even.